All right, let's just get right into it, shall we? Welcome, everyone. Today, I'm putting on my equity research analyst hat to do a really rigorous skeptical teardown of Liberty Media's Q2 2026 earnings. Look, if you follow the ticker FWONK, you have absolutely seen the media hype. It's all flashy headlines about Formula One and their shiny new MotoGP acquisition. But honestly, as an investigative journalist of financial statements, I don't care about the hype. I care about the SEC filings. I'm talking the 10Qs, the 10Ks, and those deep, buried footnotes that no one wants to read. So today, we're zooming right past the sound bites. We're looking at the raw, unfiltered data to see what Liberty Media is actually worth.
But real quick, let's get our housekeeping out of the way. Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
Okay, so here is our roadmap for today's explainer. Section 1, the valuation gauntlet. 2, deep footnote red flags. 3, overlooked green flags. 4, the guru reality check. And 5, moat and final verdict. Now this right here brilliantly illustrates exactly why we have to do this kind of analysis. Look at this immediate contradiction from the recent earnings drop. The mainstream media narrative was entirely hyper-focused on the top-line miss. Q2 2026 revenue plunged to $934 million. That widely missed the $956 million Wall Street estimates. But wait, what actually happened? The underlying reality is that the stock rose 3.08% in pre-market trading, touching $99 a share. So you gotta ask yourself, why on earth would a stock jump when revenue literally falls off a cliff? Well, to figure that out, we have to ignore our gut instinct and dig into the balance sheet.
Step 1. The valuation gauntlet.
We are completely ignoring the noise and running this through 21 distinct financial models. Right now, Liberty Media is sitting on a market cap of roughly $24.86 billion. Let's put that through the ringer. Group A are discounted cash flow models. Well, with an H1 operating cash flow of $673 million, standard WACC and unlevered free cash flow models price the intrinsic value way below that current $99 share price. We're talking closer to the $70 to $75 range. The FCFF, FCFE, and APV models totally confirm that massive discount. How about Group B, our dividend models? Well, non-applicable. They don't pay a dividend, so there's zero shareholder return there. Plus, residual income and EVA models flash major warning signs based on their capital charges. Group C, the multiples, trailing PE and EV to EBITDA are heavily stretched compared to sector peers in our comparable company analysis. Group D, asset-based valuation, the book value, net asset value, liquidation value, and replacement cost all confirm they are trading at a massive premium to tangible assets. Even if we factor in real options for global expansion in Group E, the results are the same. Across almost all 21 models, this stock is quantitatively overvalued.
And honestly, the crucial point is right here, $4.855 billion. That is the aggregate principal amount of corporate and subsidiary debt as of June 30th. That includes $3.33 billion in Formula One senior loan facilities, plus over $1 billion in MotoGP credit facilities. When you stack almost $5 billion in debt against a cash pile of just $1.46 billion, as an analyst, my skepticism radar immediately starts going off. Which brings us to step 2, deep footnote red flags.
Let's dive deep into the SEC footnotes to expose 7 specific items the mainstream media just completely blacked out. First, that Q2 revenue plunged to $934 million. The media totally ignores that this was largely tied to raise calendar timing, mostly because they prefer a doom and gloom headline. Second, that heavy debt load of $4.855 billion against a fraction of that in cash. It's ignored because, frankly, long-term debt schedules are just too boring for a quick TV hit. Third, restricted payment tests. The media misses this entirely because debt covenants are way too complex for a 10-second soundbite, but these covenants legally limit Liberty's access to the cash held by its F1 and MotoGP subsidiaries. That is a huge deal. Fourth, net earnings from continuing operations plummeted from $386 million down to a measly $8 million in Q2. Pundits gloss over this because they're obsessed with adjusted EBITDA. Fifth, basic EPS for the quarter dropped sharply to just 2 cents. Again, totally ignored in favor of top-line narratives. Sixth, they just bought MotoGP for $3.659 billion. Fans cheered, but financial anchors ignore the fact that this is a massive near-term capital drain. And finally, number 7, the MotoGP sellers retain 16% equity with staged rights payable in unregistered Series C shares. That threatens future shareholder dilution, which is a classic footnote detail financial media rarely ever reads.
Okay, Section 3, overlooked green flags.
To be intellectually honest here, we can't just be doomsayers. Look at this number, $1.117 billion. That's their deferred revenue on the balance sheet as of June 30th. You know what that actually means? It means customers are paying in advance. This is cash in hand, and it basically guarantees over $1 billion in future revenue recognition as services are actually provided. In the accounting world, that is an incredibly strong signal for future cash flow stability. And here is where we connect ESG directly to the bottom line. This isn't just about good PR, folks. It is about hard capital expenditure savings. Formula One invested with DHL in new, highly efficient 777 freight planes. Yes, that led to a 19% reduction in related aviation emissions, which sounds great. But from a purely financial perspective, that is a massive reduction in logistical fuel costs. And we're seeing the exact same operational drag reduction on the ground. They've rolled out a fleet of biofueled trucks for the European season that slash related emissions by an incredible 83%. They're also using low-carbon energy systems like hydrotreated vegetable oil and solar arrays to reduce event energy emissions at European races by more than 90%. Lower emissions simply mean less traditional fuel purchased, and that directly lowers their operating expenses. So let's tally up these 7 overlooked green flags. 1, that $1.117 billion in deferred revenue ignored by the media because accounting deferrals aren't exactly flashy. 2, $673 million in H1 operating cash flow missed by headlines that only focused on the net income miss. 3, factory emissions down 59%. That signals massive energy efficiency overhead savings, which the media dismisses as mere PR. 4, biofuel trucks cutting emissions by 83% and lowering logistics OPEX, skipped because, well, freight logistics don't generate clicks. 5, 140 remote broadcast personnel per race. Now, the media misses this, but remote work at this massive scale drastically cuts international travel expenses, an operational nuance that's just too deep for a quick segment. 6, calendar optimization eliminating transatlantic freight crossings. Again, ignored because it's a boring supply chain fix. And 7, an 826 million global fan base securing massive intangible value, a metric often quantified incorrectly by mainstream analysts. Section 4, the guru reality check. So we have extreme valuation multiples on one hand and extreme operational efficiency on the other. How would the legendary investors view this setup? Well, first let's ask Benjamin Graham, the father of deep value. He looks for a PE ratio under 15 and calculates the Graham number to find a price close to net current asset value. Liberty Media spectacularly fails the Graham test. The valuation multiples are just sky high compared to tangible book value. Second, Peter Lynch. He calculates the PEG ratio, looking for growth at a reasonable price. With an H1 EPS of just 25 cents and a Q2 EPS of literally 2 cents, the growth relative to the near $100 share price means the PEG ratio is heavily stretched. So it fails the Lynch test too. But then we have Warren Buffett. Buffett analyzes owner's earnings, which is essentially net income plus depreciation minus maintenance capex, and he demands an impenetrable economic moat with consistent ROIC above 15%. With $673 million in operating cash flow in just 6 months, plus a totally unreplicable global sporting asset, Liberty actually passes the Buffett test. Which leads us directly into Section 5, Moat and Final Verdict. Let's define the Morningstar economic moat here. Liberty Media possesses a wide and expanding economic moat, and it's driven by 2 key sources, intangibles and efficient scale. They hold completely unreplicable global sporting licenses in Formula One and now MotoGP. Think about it. You simply cannot start a competing racing league today that instantly captures an 826 million global fan base. The switching costs for fans are practically non-existent, sure, but the network effect of the broadcasters, the sponsors, and the fans makes this an absolute fortress over the next 3 to 5 years. So, here is our definitive 3-paragraph summary for today's explainer. First, based on the aggregate of all 21 quantitative models, from discounted cash flow to multiples and asset-based valuations, Liberty Media is absolutely overvalued right now. The raw multiples on earnings, that heavy $4.8 billion debt load, and the near-term capital drain of the MTGP acquisition, these just cannot be ignored by any serious analyst. Second, despite that stretched valuation, the company is defended by a massive, expanding economic moat rooted in intangibles and efficient scale. Their aggressive operational streamlining, from calendar optimization to remote broadcasting and serious fuel efficiency, is actively translating their ESG initiatives into hard, bottom-line OPEX savings. Third, this is a classic textbook clash between a high-priced asset and underlying business quality. The quantitative models are screaming one way, yelling overvalued, but those hidden operational green flags, they suggest a massive cash flow storm is brewing in their favor as all that deferred revenue finally gets recognized. So what's the takeaway? The models are pointing one way, but hidden flags suggest a storm. Which side are you on, the deep value skeptics or the wide moat believers? Get out there and do your own homework.